The monetary landscape is approaching a critical inflection point that will fundamentally reshape investment opportunities and risks across all asset classes, including precious metals like silver. Central banks worldwide are preparing to abandon the monetary tightening policies that have dominated the past 2 years in favor of renewed liquidity expansion that could create the most significant asset price acceleration in modern financial history. Understanding this transition and positioning appropriately for what markets call a potential melt-up becomes essential for investors seeking to maximize gains while avoiding the inevitable correction that follows periods of excessive monetary accommodation. Central bank policy cycles operate through predictable patterns where periods of monetary restriction intended to control inflation eventually give way to liquidity expansion designed to prevent economic contraction or financial system instability. The current cycle shows clear signs of approaching this transition point as economic growth slows, employment conditions weaken, and financial markets exhibit stress symptoms that typically prompt central bank intervention through renewed money printing and asset purchase programs. Federal Reserve officials have begun signaling increased concern about economic growth prospects, while inflation metrics show declining trends that provide justification for policy accommodation. European central bank communications reveal similar concerns about regional economic weakness that could require additional monetary support. Bank of Japan continues aggressive monetary accommodation despite global tightening trends. Bank of England faces economic pressures that limit continued tightening capability. These coordinated concerns create conditions for synchronized global liquidity expansion. Recent Federal Reserve meeting minutes explicitly acknowledge recession risks and employment market deterioration. ECB officials privately express concerns about European banking sector stability during continued tightening cycles. The mechanics of central bank liquidity expansion operate through multiple channels, including interest rate reductions, quantitative easing programs, and emergency lending facilities that inject newly created money directly into financial markets. Unlike previous accommodation cycles that occurred during obvious crisis conditions, the approaching expansion occurs while asset prices remain elevated and financial markets continue functioning normally, creating potential for dramatic price acceleration when additional liquidity encounters limited investment alternatives. Silver positioning within this monetary policy transition offers unique advantages compared to other asset classes because precious metals historically benefit from currency debasement, while simultaneously serving as inflation hedges during periods of monetary expansion. However, the timing and magnitude of silver's response to renewed liquidity expansion depends on complex interactions between monetary policy, investor sentiment, industrial demand, and supply constraints that create both opportunities and risks for positioned investors. Understanding the concept of market melt-up becomes crucial for developing appropriate silver exit strategies, because melt-up conditions create price movements that exceed fundamental justification while generating investor psychology that discourages profit-taking during optimal exit windows. Melt-up describes periods where asset prices rise rapidly due to excess liquidity and momentum-driven buying rather than improving fundamental conditions, creating temporary price levels that cannot be sustained once liquidity conditions normalize or investor sentiment shifts. Historical melt-up examples include the Japanese asset bubble of the late 1980s, the technology stock surge of 1999–2000, and the commodity supercycle peak of 2008, each demonstrating how monetary accommodation combined with investor enthusiasm can drive prices far beyond sustainable levels before inevitable corrections eliminate speculative gains. These historical examples show consistent patterns where early liquidity expansion creates genuine investment opportunities, but extended accommodation generates speculative excess that destroys wealth for investors who fail to exit appropriately. Silver's behavior during previous melt-up periods provides important insights for developing 2026 exit strategies. During the 1979-1980 precious metals surge, silver prices increased from $6 to $50 per ounce within 18 months as monetary accommodation and inflation concerns drove speculative demand. However, the majority of gains occurred during the final 6 months of the advance, with prices collapsing equally rapidly when Federal Reserve policy tightened and speculative enthusiasm reversed. The 2008 commodity melt-up saw silver advance from $14 to $21 before collapsing to $9 during the financial crisis, demonstrating how monetary policy changes can create both opportunities and risks for precious metals investors. The 2011 precious metals peak occurred when silver reached $48 following quantitative easing programs, but subsequent policy normalization drove prices below $15, illustrating the importance of exit timing during policy-driven cycles. Developing silver exit strategies for 2026 requires analyzing multiple indicators, including monetary policy signals, market sentiment metrics, technical price patterns, and fundamental supply-demand conditions that collectively determine optimal profit-taking opportunities. Rather than attempting to predict specific price levels or exact timing, effective exit strategies focus on recognizing market conditions that historically precede major corrections while maintaining flexibility to adapt to changing circumstances. Monetary policy indicators provide the most reliable signals for timing precious metals exits because central bank actions directly influence the liquidity conditions that drive speculative price advances. Key indicators include Federal Reserve balance sheet changes, interest rate policy trajectories, quantitative easing program modifications, and central bank communication regarding future policy intentions. When monetary policy shifts from accommodation toward restriction, precious metals typically face selling pressure regardless of other fundamental factors. Weekly Federal Reserve H4.1 statistical releases reveal balance sheet composition changes that precede policy announcements by several weeks. The timeline for monetary policy transitions typically extends over 12 to 18 months from initial policy signals to full implementation, providing sufficient advance notice for developing exit strategies. Central bank officials usually telegraph policy changes through speeches, meeting minutes, and economic projections before implementing actual policy modifications. Monitoring these communications provides early warning systems for investors positioned in assets that benefit from monetary accommodation. Market sentiment indicators complement monetary policy analysis by revealing investor psychology and positioning that influence precious metals price behavior during melt-up conditions. Sentiment metrics include investor surveys, futures positioning data, exchange-traded fund flows, and retail investor activity levels that collectively indicate whether markets exhibit speculative excess or maintain sustainable enthusiasm levels. Excessive bullish sentiment typically develops during late-stage melt-up conditions when mainstream media coverage intensifies. Retail investor participation increases dramatically, and professional investors begin reducing exposure despite continued price advances. These sentiment extremes often coincide with optimal exit opportunities because widespread optimism indicates limited additional buying power while creating conditions for sentiment reversals that trigger price corrections. Technical analysis provides additional tools for identifying potential exit points through price pattern recognition, momentum indicators, and support resistance levels that reveal market structure changes. Technical indicators become particularly valuable during melt-up conditions because fundamental analysis becomes less reliable when prices exceed logical valuation levels based on traditional metrics. Key technical signals for precious metals exits include momentum divergences, where prices continue rising while underlying buying power weakens, volume patterns that suggest institutional distribution, and chart formations that historically precede major corrections. However, Technical analysis during melt-up conditions requires careful interpretation because normal pattern relationships can remain distorted for extended periods during speculative advances. Relative strength index divergences often appear months before actual price reversals during extended bull markets. Silver-specific fundamental factors influence exit timing through supply-demand dynamics that operate independently from monetary policy and market sentiment considerations. Industrial silver demand, mining production levels, investment flows, and inventory changes all affect price sustainability during speculative advances. Understanding these fundamental factors helps distinguish between price moves supported by genuine supply-demand improvements versus purely speculative advances driven by monetary accommodation. Industrial silver demand provides price support during economic expansion phases but can decline rapidly during recessions that often follow melt-up periods. Investment demand for silver typically increases during monetary accommodation, but reverses quickly when policy tightening begins. Mining supply responds slowly to price changes, creating temporary shortages during rapid price advances, but eventually increasing production that pressures prices lower. The geographic and political dimensions of silver markets influence exit strategy considerations because international monetary policies, trade relationships, and currency dynamics affect precious metals differently across various regions. Understanding these international factors becomes particularly important for 2026 planning because global monetary policy coordination may create synchronized liquidity conditions that amplify both melt-up potential and correction risks. Currency devaluation concerns drive precious metals demand during monetary expansion phases, but currency stability reduces this demand source when central bank policies normalize. International trade tensions can create both positive and negative influences on precious metals, depending on their impact on currency confidence and economic stability. Geopolitical events often provide temporary support for precious metals but rarely create sustainable long-term price advances. Risk management principles become critically important during melt-up conditions because the same monetary policies that create profit opportunities also generate systemic risks that can eliminate gains rapidly when conditions change. Effective risk management during speculative advance periods requires position sizing that allows participation in potential gains while limiting losses if corrections occur unexpectedly. Leverage considerations become particularly crucial during melt-up planning because borrowed money amplifies both gains and losses during volatile market conditions. While leverage can enhance returns during favorable conditions, it also creates forced selling pressure during corrections that can transform temporary setbacks into permanent losses. Conservative position sizing with minimal leverage provides flexibility to maintain positions through volatility while avoiding forced exits during unfavorable conditions. Margin calls during volatile periods can force liquidation at precisely the worst possible timing for investor outcomes. Portfolio diversification across different asset classes and geographic regions provides protection against silver-specific risks while maintaining exposure to monetary policy benefits. Diversification strategies should account for correlation changes that occur during crisis periods, when assets that normally move independently often decline together. Maintaining some positions in assets that benefit from monetary restriction provides balance against precious metals positions that suffer when accommodation policies reverse. Liquidity monitoring provides more reliable guidance for investment decisions than headline economic news or political developments, because liquidity conditions directly influence asset prices, regardless of fundamental developments. Central bank balance sheets, money supply growth rates, credit creation metrics, and financial market liquidity measures collectively indicate the monetary environment that determines investment opportunity and risk levels. Professional investors focus on liquidity flow analysis rather than economic forecasting, because liquidity changes affect all asset classes, while economic predictions often prove incorrect or irrelevant for market timing purposes. Tracking Federal Reserve balance sheet changes, Treasury General Account fluctuations, reverse repurchase agreement volumes, and commercial bank reserve levels provides direct insight into liquidity conditions that drive market movements. The timeline approaching 2026 presents several critical considerations for silver exit planning, including potential changes in Federal Reserve leadership, election cycle influences on monetary policy, international monetary system evolution, and technological developments that could affect precious metals demand or supply. These longer-term factors create uncertainty that requires flexible exit strategies rather than rigid, predetermined timing. Federal Reserve policy transitions often coincide with leadership changes that can alter monetary policy approaches and communication styles. Understanding potential policy evolution helps investors anticipate timing and magnitude of accommodation cycles while recognizing that new leadership can create unexpected policy shifts that affect market dynamics. Election cycles influence monetary policy through political pressures that encourage accommodation during election years and potential policy changes following elections. These political influences can accelerate or delay monetary policy transitions while creating additional uncertainty about policy consistency and duration. International monetary system developments, including central bank digital currencies, alternative reserve currencies, and changing trade relationships, could affect precious metals' role as monetary assets. While these developments typically occur gradually, they create long-term structural changes that influence precious metals investment attractiveness over multi-year periods. Technology developments in mining, recycling, and industrial applications continually modify silver supply and demand fundamentals. Understanding these technological trends helps investors distinguish between temporary price movements driven by monetary policy and permanent changes in silver market structure that require different investment approaches. Developing specific exit criteria involves establishing measurable conditions that trigger profit-taking decisions rather than relying on subjective market timing attempts. Effective exit criteria combine monetary policy indicators, sentiment measures, technical signals, and fundamental developments into objective decision frameworks that reduce emotional decision-making during volatile market conditions. Monetary policy exit triggers might include Federal Reserve balance sheet reduction announcements, interest rate increase schedules, or quantitative easing program termination dates. Sentiment exit triggers could involve investor survey extremes, media coverage intensity levels, or retail investor participation rates that historically coincide with market tops. Technical exit signals might include specific price levels, momentum divergences, or chart pattern completions that suggest trend changes. Fundamental exit criteria could involve industrial demand changes, supply increases, or inventory level modifications that affect long-term price sustainability. The psychological challenges of exit timing during melt-up conditions require preparation because human nature encourages continued holding during profitable periods while creating reluctance to realize gains that could continue growing. Understanding these psychological tendencies helps investors develop discipline necessary for executing exit strategies when conditions become favorable. Professional investors often use systematic position reduction strategies that scale out of positions gradually rather than attempting to time exact market tops. This approach reduces the pressure to make perfect timing decisions while ensuring profit realization during favorable conditions. Scale-out strategies typically involve selling predetermined position percentages at specific price levels or time intervals. Final considerations for 2026 silver exit planning include maintaining awareness of unexpected developments that could accelerate or delay the monetary policy cycle, preparing alternative exit strategies for different scenarios, and avoiding overconfidence about specific timing predictions. Market conditions evolve continuously, requiring flexible approaches that adapt to changing circumstances rather than rigid adherence to predetermined plans. The approaching monetary policy transition creates both exceptional opportunities and significant risks for precious metals investors. Understanding the melt-up dynamics, monitoring liquidity conditions, and preparing flexible exit strategies become essential for navigating this challenging environment successfully. While specific timing remains unpredictable, recognizing the patterns and preparing appropriate responses provides the foundation for successful precious metals investment during this critical period. This analysis examines observable monetary policy trends and historical market patterns rather than providing specific investment advice or guaranteed outcomes. Market conditions remain subject to unexpected changes that can alter investment landscapes rapidly. Understanding these dynamics provides context for developing personal investment strategies while recognizing the inherent uncertainties in market timing and policy prediction.